The idea of a war between the United States and Iran isn't just a military headline. It's an economic shockwave that can travel across the entire world in days. Even before a single missile is fired, markets move, prices rise, and governments prepare for damage control. To understand why, we need to look at how deeply this conflict is tied to the global economy. Tensions between the US and Iran have been building for years, driven by nuclear disagreements, sanctions, regional proxy conflicts, and military posturing in the Middle East. When these tensions escalate toward the possibility of war, investors don't wait for confirmation. They react immediately, because the economic consequences are both predictable and severe. The first and most critical reason the world panics is oil. Iran sits next to the Strait of Hormuz, a narrow but extremely important shipping route through which roughly 1/5 of the world's oil supply passes every single day. If a war breaks out, even the threat of disruption in this strait can send oil prices skyrocketing. History shows that oil markets price fear faster than reality. A partial blockade, a naval clash, or even missile activity nearby could push crude oil prices well above $100 per barrel within weeks. When oil prices rise, inflation follows. Fuel becomes more expensive, transportation costs increase, and businesses pass these costs on to consumers. Food prices rise because agriculture relies on fuel. Airline tickets become more expensive. Shipping costs go up, making imported goods costlier. What starts as a regional conflict quickly turns into a global cost of living crisis. For the United States, the situation is complex. While the US produces a large amount of oil domestically, it is still deeply connected to global energy markets. Higher global oil prices raise fuel costs for American consumers and businesses. Inflation pressures increase, forcing the Federal Reserve into a difficult position. If inflation rises too fast, interest rates may need to stay higher for longer, slowing down economic growth, reducing consumer spending, and putting pressure on stock markets. Stock markets hate uncertainty, and a US-Iran war creates massive uncertainty. During periods of heightened tension, investors pull money out of riskier assets and move into safe havens such as gold, US Treasury bonds, and the US dollar. This leads to stock market declines, especially in sectors tied to stable energy prices, global trade, or consumer confidence. Technology stocks, airlines, logistics companies, and emerging market equities are often hit the hardest. Iran's own economy would suffer immediate and severe damage. The country is already under heavy sanctions, limiting its ability to export oil and access global financial systems. A war would worsen inflation, weaken its currency further, and cause capital flight as businesses and citizens try to protect their savings. The Iranian stock market would likely crash, unemployment would rise, and government revenues would shrink just as military spending explodes. The effects don't stop there. Europe, which already struggles with energy security, would face renewed pressure on gas and oil supplies. Higher energy prices would hurt manufacturing competitiveness, increase household energy bills, and slow economic recovery. Emerging economies would be among the biggest losers. Nations in Asia, Africa, and Latin America that depend heavily on oil imports would see their trade deficits widen. Their currencies could weaken as more dollars are needed to pay for energy imports, leading to higher inflation and rising interest rates. In extreme cases, balance of payments crises emerge. For poorer countries, this means reduced government spending on healthcare, education, and infrastructure. Some oil-exporting countries may benefit in the short term. Higher oil prices increase revenues for major producers like Saudi Arabia, the UAE, and Russia. However, these gains come with risks. Instability scares away long-term investors, raises shipping insurance costs, and threatens diversification plans. Sanctions play a crucial role. If the conflict escalates, sanctions on Iran would almost certainly tighten further, isolating the economy and reducing export capacity. Globally, institutions like the IMF warn that sharp energy price spikes act like a tax on the world economy. Consumers spend more on fuel and less on everything else. Looking ahead, outcomes hinge on the path of the conflict. Diplomacy and easing tensions bring stabilization. A limited conflict keeps volatility elevated. A prolonged supply disruption risks global inflation, slower growth, and recessions. In the end, a US-Iran war is not just about missiles and military strategy. It's about prices at the pump, food costs, interest rates, and jobs worldwide. The global economy is tightly connected, so every headline, meeting, and movement matters. Because today, war is also fought through prices, markets, and everyday lives. Subscribe to EconMatrix, where economics meets reality.